So hello, everybody out there. My name is Abby Bauer, and I'm an associate editor for Hoards Dairyman magazine. I want to thank you for joining us for today's webinar, which is titled The Dairy Situation and Outlook for 2020. Our presenter is Mark Stephenson, who comes to us from the University of Wisconsin-Madison. And we're very pleased to have him joining us today. Hoards Dairyman and the University of Illinois have been doing these presentations and hosting webinars since 2011. So we are nearly a decade worth of webinars, and we're really excited to have a great presentation and a super presenter with us to kick off 2020. Our sponsor for this webinar is Zinpro Performance Minerals. You see their logo there on the screen. We want to thank them for supporting this program. We really appreciate that. Our webinar team consists of Jim Baltz with the University of Illinois and our Hoards Dairyman online media manager, Patty Hirchin, who both do a lot of work behind the scenes to make sure these webinars come together each month. And then my co-host is Mike Hutchins, a professor emeritus from the University of Illinois and a very well-known dairy nutrition specialist. So thank you, Mike, for joining as well. For all of you who are listening live today, the PDFs of the presentation slides are available. If you go to the GoToWebinar control panel and the handout section, which is down near the bottom, you can click on those links and print off a copy of the slides if you'd like to use them for your reference later or to take notes on them. And also, if any questions come up during the presentation, feel free to type them into the questions section, and we'll have a Q&A time at the end of the presentation where Mark will address those questions. Mike, I think that's everything I have for now. So if you would please introduce Mark, and we can get started on this month's webinar.
Well, thank you very much, Abby, and it's my professional and personal pleasure to introduce Dr. Mark Stephenson. Mark is a native of Michigan. Dr. Stephenson received his bachelor's and master's degree from Michigan State University in dairy science, and then later a master's and PhD degree in ag economics from Cornell University. He holds two titles, actually. He's a director of dairy policy and analysis at the University of Wisconsin in Madison, and that involves looking at various aspects of the dairy industry, technologies, pricing, costs, and those kinds of factors as well. His second title is Director of Wisconsin Center for Dairy Profitability. In this capacity, he works with faculty and staff to coordinate a multidisciplinary approach to dairy farm level problem solving and planning. So, Dr. Stephenson, we'll turn the microphone over to you, and welcome to our Hoards Dairyman webinar kicking off 2020.
Thanks, Mike. Appreciate it very much, and that was a very nice introduction. I am going to be looking at the situation and outlook for 2020, and I think that we've got a number of things that I'd like to start with. One of them is that I'll just tell you up front that I would kind of entitle this, "It's a better outlook this year." But I also put up there, couldn't be an economist if I didn't at least have a couple of qualifiers in there. So I say with a couple of asterisks. And I'm pleased to be here, and I want to start out with the general economy. Our economy's been strong. We've gone through the last recession, which was 2008-9 time period. And as you can see, at that point in time, we had an unemployment rate that reached 10%. That was devastating. It was a worldwide recession. And since that time period, we have eroded the unemployment rate to a level of about 3.5% the last month. This is historically low. In fact, it's low enough that there are difficulties around the country trying to find adequate employee numbers for the available jobs. And I think that many of our dairy farms would agree with that that's been a bit of an issue for them. So I want to start off actually after this slide with a poll. And this poll is going to be one where we try to take a look at what we actually think the economy is going to be. And I'd like your expectations for this.
Well, very good. Here's your chance to vote. The question is, what is your expectation for the general U.S. economy over the next 2 years? And you have 1 of 4 choices. You only can pick one. The first one is, it should be great with continued strong growth. Number 2, I expect it to be okay with moderate growth. Number 3, I expect a slowdown, not a recession, but slower growth. And fourthly, I'm worried about a recession. So there's your choices, and they're off and running. We're getting lots of votes in here. Abby, do you want to make your vote public, or are you going to pass on this one?
Oh, you're right. These are going to be questions that kind of make you think here. So, basing it, I don't have a lot of data to go behind my choice. I'm going to pick the second option to say it's okay with moderate growth, maybe not great, but okay. What do you think, Mike?
I'm going to join you. I'm going to go with number 2 as well, man. You could put Democrat, Republicans, and others behind these, but we'll just leave that alone. Let's close the poll, Jim, if you could, and we'll share the results with Mark. And Mark, you may want to make a comment on what do you think the audience is thinking?
Well, I take a look at this and I listen to both you and Abby, and I think that most folks are falling into that same camp. We are expecting moderate growth, or else maybe a bit of a slowdown, but not a recession. And, I'm actually feeling okay with that kind of thing. But I want you to take a note that the poll did say over the next 2 years. So maybe that was a bit of a subtlety here as opposed to just this next year. If I get back here and look at some of our next slides, I want to give you a couple of things that may be sort of qualifiers to that. This is a little different way to take a look at the economy. This particular chart here is showing you just a simple difference between a 10-year Treasury bill and a 2-year Treasury bill. It's oftentimes called the spread, and you'll notice that there is up and down in all of this kind of a measure here, but we are at a place where we're in a down phase of this Treasury bill spread. Now, you'd like to have a higher interest rate for something like a 10-year time period, because that's indicative of the fact that we are enthusiastic about the future. If we get to where we're have a fairly low 10-year spread or a 10-year T-bill rate relative to the 2-year, it's just kind of saying, I want my money up front. I don't want to bet on the future so much. This particular measure of the economy has correctly predicted all 7 recessions that we've had over the last 50 years. Those yellow bars are showing you time periods when we've had technical recessions. There was only one false positive that it's ever predicted. And if you do take a look at where those yellow bars are relative to the blue line on the chart, you'll notice that we bottom out, generally speaking, with this T-bill rate. And then as it starts to go up, we are sliding into recession. I would look at this. This is sometimes, by the way, called an inverted yield curve. And I would say when you take a look at our current difference between the 10 and 2-year rate, we're at a point in time where we can anticipate slower growth at the very least, and possibly something like a recession. Now, personally, I don't think that that's going to happen until we get at least past our election this end of the year in 2020. But I think at that point in time, it's going to be hard to hold that back. And I think we are looking at a slowdown. That impacts dairy product sales as well. And so we need to be a little bit concerned about that, perhaps. I'm going to take a look at one other measure, and this is called the Consumer Confidence Interval. It's a survey that's done monthly in the US here, and phone calls to just general consumers like you and like me are asked questions about how do you feel about the economy today? That's the blue line right there, called the present situation. And they're also asked another set of questions, such as, how do you feel about the economy in the near future, about 6 months or so from now? That's the green line. What we actually see reported mostly is this red line, which is a simple average between the two. Generally speaking, consumer confidence has been up. But I do want you to take a look at the spread between these two. If you go back to this time period over here in 2007 and 8, you'll notice that consumers are feeling pretty good about the present situation. This was a time period when you said, my 401k is great. The economy seems to be rolling along at a great pace. Couldn't be better. But what? Down here in the green, I'm concerned about the future. Now, when that happens, quite often we get conservative with our purchases. We don't maybe go out to eat quite as often, or we put off the purchase of another vehicle. And those kind of things can send our economy into a downturn. And that's what we saw in part happening during this 2008 and 9 time period. Since then, we've recovered tremendously. And as you'll notice, the blue line in our current time period indicates a very strong consumer confidence. But the spread between the present and our expectations for the future is even bigger right now. So I think this is one of my asterisks that I'm going to share with you. And I would say we need to be a little bit cautious about the future. Now, this consumer confidence really falls into our consumption of things in the economy. If you take a look at the general economy, our growth usually measured by gross domestic product, you'll notice different countries shown here. In the United States, our gross domestic product is about 71% based on consumption. If you take a look at the other end of this chart, China has only about 34% that's based on consumption. Much of the rest of the growth in gross domestic product at China comes from investment. They're pouring concrete and steel and buildings and doing some other things in infrastructure that will have longer term payouts. And I don't share this to say that one is good and one is bad. It's just different, but there are consequences to being different. If consumption falls off, our economy will fall off too. So let's hope that consumers stay reasonably confident about the economy. We've changed gears over the last decade and a half in this country. And I'm trying to show that here in 2 lines on this chart. The blue line measured off the left-hand axis is the percent of our milk production that we sell as exports of dairy products. That has been increasing at a fairly stable rate with some upturns and downturns over this time period. And, we were not much of a player in world markets back in 2000, the year 2000. 3 or 4% was a typical export number for us for decades prior to that. And it began to take off in 2004 and 5, and we've been growing most of the time ever since. On the right-hand side, I'm showing you the U.S. all milk price measured in dollars per hundredweight. And that's the orange line that we see in the chart. Now, I show this on here because I want to draw your attention to the correspondence between these 2 things. When we have seen exports either plateau from the expected rise they were having or even drop off here, you'll notice that we've had a pretty big decline in milk prices. Same thing was true here during this time period, pretty big decline. And if you look over here, this is our 2008 and 9, a time period in dairy when we really don't want to revisit, at least in the year 2009. This had much to do with the recession during that time period. This was not just a U.S. recession, it was a global recession. And many of the countries that we were selling products to simply couldn't afford or didn't want as much dairy product as we wanted to send to them. So those products stayed home and the price ultimately had to fall to clear the marketplace here. We've been in this prolonged downturn. And you'll notice over here, clear on the right-hand side, that our U.S. all milk price is starting to rebound now. We've got some optimism in prices, and I think this is going to continue. And it's not because our average exports are really so high. Normally, I would expect to have said we need them to be about 17 or 18% before we have complete recovery in milk prices. But we're getting part of this because the milk supply has actually experienced slow growth, even declines in a couple of months. So that kind of impact is something that we have to watch out for. Now, what happens when we can't sell as much product overseas? What happens is that the first thing is that our stocks begin to build. So product that we expected to sell to overseas customers stay at home. And initially, those stocks get larger. When they get too large, prices fall. You'll notice in 2015, there's typically a seasonal pattern where stocks would increase through the flush season of the year and then be drawn down and decline through the rest. That didn't happen in 2015. They built and then finally plateaued in the 4th quarter. 2016, we still had build. There was a little bit of drawdown, but they were higher than normal. 2017, same kind of thing, drawdown, but at higher levels. 2018, they built on through fourth quarter. And it wasn't really until this last year, 2019, when we began to pull those stock levels down. And that's why I'm suggesting here that we have some optimism. And one of the reasons that we've seen price strengthening here in November in our last milk check. Let's take a look at another product though, and that's butter. These, by the way, are just for storable products. This shows you very clearly, I think, what our seasonality looks like in terms of stock buildup. Flush season, we're producing a fair amount of surplus cream. We churn butter and we put that away, and then we draw it down during the larger demand season of the year. And while the scale masks some of this, you'll notice in November that this level of stocks for dairy or for butter products here was quite a bit higher. And that, I think, reflects some pessimism. And we've also seen that being pecked away at with prices here recently. Now, let's take a look at what happens. This is another consequence of being heavily involved in world dairy markets. By the way, as an exporter, we're the third largest in the world after the UK and after, or not the UK, after the European Union and after Oceania, primarily New Zealand. Those two groups of countries are shown here. The green line is Oceania, and the blue line here is European Union, and this is the price for butter. Red line is the US. When our butter prices start to get about so far above where these world prices are, if it lasts long enough, we become a destination for those other countries to send us butter. And we've imported quite a bit more in 2019. That gap is closing, and we're starting to slow down the imports of butter. But, you know, when we start to get too far afield with prices, we get roped back in. Let's take a look at cheese. You'll notice here, again, green line, we have Oceania cheese prices, and red line is US cheese price. And here we've got a divergence that's large and growing larger over the last few months. This is likely, I think, to put continued downward pressure on cheese prices, and it's one of the reasons that we're seeing cheese prices soften right now. So being involved in world markets has upside potential, but it can also have downside draw too on milk prices from time to time. It's normal for the United States to have somewhere between a 1% and a 2% increase in US milk production. There's variability around that range, but anytime it's much larger than 2%, it better be there for a pretty good reason, like we've found some new demand for dairy products. Otherwise, we can start to build up stocks and those prices get to feel burdensome. You can see in 2014 what happened when we responded to those excellent milk prices at the farm, that we plunged ourselves into relatively low milk prices, and we had to slow from those levels. Now, really, from about 2017 onward, we've been in quite a contraction in terms of milk price or milk production, at least much slower growth. We've had a few months below year earlier levels, but for the most part, our growth has been in that 0.5% range. So we have been slowing down milk production rather considerably. Two components of milk production are really number of cows and the productivity of the milk per cow that we're selling. Here's what's happened with the number of cows. Again, 2014, strong milk price. That's a market sending us a signal that says we want more milk. We were happy to oblige. We started to throw on cows. And even in 2016, when prices had collapsed, we were still adding cows to the US herd. That green line is showing that upward trend. 2017, the same sort of thing. It really wasn't until 2018 when these persistently low milk prices began to bite at the farm level, and we started not just moving cows from one farm to another as we had a higher number of dairy farms exit the business, but we actually began to lose dairy cows. And that's continued at a slower pace in 2019. So our cow numbers are tighter than they had been before. But milk per cow is such a persistent trend in this U.S. market that while there's a seasonal component to it, peaks during the flush and during the fall, we have tighter markets, generally speaking. You'll notice that we do have growth year over year, and we've had some of that growth in this particular year, especially as we're starting to try to respond to stronger milk prices out here in the fourth quarter, October, November, and December. Producers are trying to repair some of the balance sheets that have been damaged over the previous 4 years. But milk per cow per day is getting to be hard, I think, to persist. And some of that has been that we've had problems with feed more recently. USDA had a higher forecast for milk production per cow than I've had for quite a while, but just a couple of days ago or last week early, they last USDA report did lower their expectations for milk yield in cow per day. Quite a bit of differences around the country in terms of forage quantity and quality, but I would like to see if we couldn't run a poll question on that. These are all about quantity and quality, so read them carefully when you're doing the poll.
Oh, very good, Mark. You can take a quick rest here. What is the feed situation in your region or in your country, as it would apply as well? There are 4 choices. Number 1, adequate forage quantity and quality. Both are there. Adequate forage quantity, but quality is poor. That's your second choice. Your third choice is short on forages, but the quality is good. And fourthly is short on forages and quality is poor. Wow, wait, this will slow down the voting, I would think. Although, wow, we got 50% of the vote in already, and we got a big audience out there. Abby, where are you going to vote?
I think, like Mark alluded to, I think definitely differences by region, and then I think even farm to farm, just the type of soil and being able to get the feed planted and then get it off. So I don't know, I guess what do you feel in kind of your area would be a fair analysis?
Well, I'm going to probably get in trouble here, but I'm going to pick number 4. I think we're going to see some shortages of forages because of the growing season here in Illinois. And then the quality is poor, primarily because of late chopping of corn silage and in some cases very losing third and fourth cuttings because of dry conditions. So we've got 2/3 the vote in. Let's go ahead, Jim, and close the poll and let Mark see the results here. And the results are interesting. Mark, what do you think?
Wow. If this were restricted to Wisconsin producers, there would have been a little bit of difference between, whether you had adequate quantities or not, but quality is not great in most parts of the state. But I don't think anybody would have been saying things like, forage quality is great and I got plenty of it. So this is a fairly balanced response overall. I'm a little bit surprised, but there is still, half of the forage quantity that appears to be tight. And that's a pretty measurable number. Well, yeah, that's going to help us think a little bit more about just what life looks like, I think, when we've got expectations for milk production per cow. So we've seen that we're losing cows over the last year and a half, and this cow loss is also measured in farm loss. We don't have data for all states, but Wisconsin does publish a monthly number of licensed dairy farms. And when we look at this, it is a surprising thing to see how that's been increasing here over the last few years. 2016 is showing you a fairly normal kind of attrition rate for dairy farms in this state. We peaked, by the way, in the US dairy farms in the mid-1930s, and with about 3.5 million dairy farms. And today we're in the 30,000 range. So we've declined a great deal. We've had consolidation for a long time. 2016, 3.5 to 4% dairy farm loss. But in 2017, that started to creep up in the state of Wisconsin, continued through 2018 and 2019. And we've seen some headlines just in the last few weeks when our Department of Agriculture published the attrition rate for the year at a little above 10%. That's a large percentage loss, not the biggest actual number loss that we've seen, as I noticed that Corey had an article just today in the Intel. But nevertheless, it's a big percentage loss. This has been a little bit different around the country. The regional changes in milk production, and by the way, I'm sorry, but we don't have all of 2019 yet. So I'm comparing the first 3 quarters of 2019 to those same 3 quarters in 2018. In general, that southeastern part of the United States has been in decline, with the exceptions of Mississippi and Georgia and Florida, but otherwise pretty much in decline through that entire region. So milk supply is tightening, and even the growth in states like Michigan or New York has been modest in comparison to recent years. Texas and Oklahoma are really 2 states that have had a pretty big jump in growth, and Texas has been doing this for the last several years. California is measuring that uptick in milk production in part due to a low milk production the year before. But clearly there are some regional differences in milk production and milk supplies that have been going on. We have to look outside our borders. As long as we're a part of the major exporters, they also represent competition for us for the sales of those products. And I'm showing you 2 things here. One is a percent change in U.S. milk production in the red line, and the other is a percent change in milk production from 5 major exporting countries or regions of the world. That includes the U.S., but it also includes the European Union, New Zealand, Australia, and Argentina. And you'll notice that everybody has been on a tightening production here really since 2017. So milk production is slowing down worldwide and from the major exporting countries. And that's giving us a chance to tighten up not just our own milk production and stocks of dairy products, but also international ones as well. When we take a look at one of the things that was an issue kind of overhanging world markets, this was intervention stocks of skim milk powder that the European Union bought to try to help bolster milk prices. Now, this is a program that was very similar to our price support program that the U.S. Operated for many years, when the government would buy dairy products, storable dairy products off the marketplace and hold them for a period of time, and when prices recovered, would sell them back to the market. The EU's intervention stocks from 2016 through 2018 were large, and we just couldn't get skim milk prices or non-fat dry milk prices up off the floor as long as those stocks were there. But through 2019, they rather rapidly worked those supplies down, and they're gone at this point in time. Now that they're gone, we're seeing some life in skim milk markets and in through our pricing system, Class 4. So I'd like to ask you another poll question here, and that's about your expectations for exports.
Ready to vote. What are your expectations for the export competition in the next 2 years? And again, you have 4 choices. The first one is New Zealand and the European Union will significantly expand milk production exports. Second one is New Zealand will expand, but the EU will hold steady. The third one, New Zealand will hold steady, but the EU will grow. And the fourth one is New Zealand and the EU will not grow significantly. Holy smokers, Abby, good luck on this one. I tell you, if I knew something, I'd vote confidently. But I tell you, we got 50% of the vote in already. They're just amazing. All the Democrats, Republicans are warming up, I guess, for the big vote in the Senate. Abby, you going to take a swing at this?
Sure. Yeah, we have some active listeners today, so that's great. People are chiming in with their opinions. Perfect. Again, this is pretty much a guess, but I just feel like there's so much in the news about different regulations and then weather crisis in different parts of the world. So I think I'm going to go with the fourth choice, that not a significant growth in either one of those regions. And that's what I'm going with. Any guesses, Mike?
Yeah, I'm going to guess number 3, mainly because New Zealand doesn't make any more land, and they're having some environmental challenges as well. But boy, there are some Eastern European countries, that Poland and Hungary, that have tremendous land and potential. But I'm not the expert, Mark. Let's show the results here, Jim, and hear from the expert.
I do think that there's wisdom in crowdsourcing. None of us are really an expert on questions like this, but collectively, I think quite often we fall into received wisdom here. And I'm with the group. I'm not sure that New Zealand and the European Union can grow significantly. For one thing, weather's been an issue. As you pointed out, Mike, New Zealand is acknowledging some of the environmental concerns that they have on a relatively small footprint of land. They would have to change their style of dairying significantly to have great increases in milk production. And the EU, I agree, we've got some countries with resources to grow, but I don't think they're going to do it this next year. I think we're being circumspect. So I thank everybody for their poll numbers on here. It's useful. I want to shift gears just a little bit to take a look at dairy products from the consumer's point of view. I do hear people saying all the time, man, those farm milk prices go up and down, but retail prices only go up. That's not quite true. If you take a look at 2014, these are index of retail prices for dairy products around the country. And in 2014, when our farm milk price was the highest ever, so too were our dairy product prices. And since the farm prices have eroded, we see that reflected at retail. Now, not the kind of scope and scale of volatility we see on dairy farms. The supply chain buffers those things. But dairy products have been a good buy, and consumers have been stepping up to buy them. That's not through quite all of our product categories, though, and fluid milk sales do continue to slide. It's been headline grabbing news, not just for our dairy community, but for the entire U.S. to see not only Dean Foods and most recently Borden's declare bankruptcy here. And certainly part of it is due to this particular competition in the segment. Fluid milk is a beverage, and there's been a lot of competition in the beverage space, from plant-based beverages to water. And that's been part of the problem. I think we also fight demographics. We just don't have as many kids, which are our large milk consuming segment of the age spectrum. And the other thing is that, cereal sales are really on the floor. And cereal is a companion product for milk. When I grew up, I maybe had 2 or 3 boxes of cereal on the table every morning. I got to pick one of those cereals, but it was always going to be milk used there. I don't consume milk so much anymore at breakfast time or cold cereal, but I open the refrigerator and I grab for a carton of yogurt. So I've been shifting categories a little bit. And so while fluid milk sales have continued to slide, and I'm not sure when we're going to shore those up or let this be a plateau point, we do have some good news stories to share with you. When you look at these segments that I'm showing here, 2 of them are cheese. The orange is American style cheese, and the green are other cheeses. That includes Italian as well as our specialty cheeses. Those have been growth categories. Man, you go back to the 1970s, we were consuming about 13 pounds or 14 pounds per capita of cheese. Last year, we hit an all-time high at a little above 38 pounds. So we have more than doubled consumption of cheese over this time period. Yogurt has been a growth category until the last few years, when that's kind of slowed down a bit, but it still consumed a lot more milk. And, butter is back again. We are increasing the growth on that product. When you look at milk used in all dairy products domestically, we hit the highest level of consumption since the mid-1960s last year. And that's a good news story. So we can feel bad about fluid milk, but I think that taken in total from a dairy farmer's perspective, it's not all a bad news story. We've had some pretty good news for consumption of dairy products too. So we've had trade tensions, but I think there's still going to be some opportunities for us. This Wednesday, we are supposed to have a delegation from China that I understand is in Washington right now, meet and sign a phase 1 trade treaty. I'm not sure what that means yet. I'll be anxious to look and see whether there are any specific provisions in there for dairy, but we've certainly had purported that there'll be significant agricultural purchases on the part of China. And, you know, dairy in China still, I think, has a great deal of potential. Average consumption there is about 75 pounds of milk equivalent per person, while the world average is a little over 100. US average is about 640 pounds per person. And we're on the high end of that range of consumption around the globe. But there are countries like Germany and France and others in Europe where dairy product consumption is even greater than our own. So, you know, I think we've got an opportunity with China in the future here. Historically, they've purchased a lot of our whey products, and we're negotiating that trade. I hope that the phase 1 restores some of that, because as I'll show you in a moment, certainly whey product sales have been well off for us. China has also had consolidation happening on their dairy farms, and their small dairies are exiting at a rate that's faster than the mid-size and large dairies are growing. They've actually had a loss in milk production in part as a result of this over the last couple of years. So they want and need some dairy products. The other thing that's true is that their African swine fever in pork has caused a kind of a protein shifting, looking at beverage, or not beverage milk, but milk powders as being a good source, an affordable source of protein to replace some of that short-term hog loss. And, you know, we've also got this US-Mexico-Canada agreement. Those are our number 1 with Mexico and 3 with Canada trading partners. And with Mexico, we kind of fight our way back to where we were with NAFTA, which is free trade in dairy products. But there's a slightly improved access to Canadian markets for some products. And I expect that this will be ratified within the next month or so, maybe less than that. And that will be a modest improvement for the US dairy industry. Mexico has started to purchase product again, so I guess we're done being mad at each other for our trade tariffs, and that's a good thing. This is a slide that I've borrowed, a snapshot from USDEC, and it's showing you several different things on here. Let's focus clear over on the left-hand side. This is showing you 2019 in comparison to 2018 on export volumes by volume. And we noticed that this was a decline from 2018 to 2019. So we actually shipped less product. And you can see what the makeup of that was. Certainly milk powders had declined. Cheese was actually up a small tick. Butterfat was down some, and whey products were down significantly. If you look over here, however, at the far right, you'll notice that the difference between 2018 and 19 in value was up. We shipped less volume of product, but the price was higher, so the value of the product shipped was higher. That's part of a good news story for us for exports. Let's take a look at just some individual countries for some of the products that are important. For cheese exports, Mexico declined a little bit, but they've had some up months. And part of the strength that we've seen, at least through October, which is what these slides are showing you, sales through October, we have had South Korea and Japan and the Mideast, North African countries and Central America, all where sales of cheese exports were somewhat higher. If you take a look at skim milk powder and non-fat dry milk powder, It was down to Mexico and Asia, two of our larger destinations, down also to China, largely because of the retaliatory tariffs. And, it was largely a down year for most of our major export destinations. Excuse me. I had a quick jump there. The total whey exports, however, is the one I really wanted to point you to. Take a look at China's sales. They were half of what they were before. Some of this was due to the African swine fever, but mostly it was due, I think, to what was happening with our tariffs, retaliatory tariffs that we were receiving. If we can get past that, that would be a good thing. We've had an alternative to producing milk, and that's culling some dairy cows. We've done more of that recently, and I suppose it's a little ironic, but in 2014, when our milk prices were highest, so too were cull cow prices. That was partially because we weren't selling a lot of cows into the cull market, and the market would have been happy for some of that beef. But at this point in time, our cull cow prices have not really dwindled a lot over the last 2 or 3 years, but a little bit of up and down. Certainly nothing to be excited about, though. So the alternative to producing milk has not been great. There are some other factors, and I would like to take a look at that, I guess. We've had this change from our margin protection program to the dairy margin coverage program. If you're looking at this program for the purposes of risk management, especially for smaller dairies, it's a promising program. In 2019, the net benefit was almost 40 cents a hundredweight if you invested at the 950 level for tier 1. But we have no projected payments for 2020. Still, for a risk management program, this is quite an inexpensive one to do. We've also seen a lot more genomics testing and been breeding low-end cows to beef bulls. As a result of that, we've got fewer heifers in the pipeline, which means that even if we had another 2014, we couldn't jump at it as quickly as we did before. We simply don't have the kind of replacement animals available that we did then. And in just talking with some of our larger producers around the country, they're not really looking for expansion opportunities at this point in time. They're much more circumspect about growth after this prolonged downturn. And I do think that the more general economic downturn that I hinted at with that first slide, or second slide anyway, that was suggesting that we probably will have a slowdown in our economy, is the one thing that could temper my expectations for a more complete milk price recovery. Given all of that, I put this together, and here are the solid lines representing the prices we've had, and the dashed lines are representing my forecast prices for the year ahead. You'll notice that we are headed now into a downturn in prices over the next couple of months, 3 months or so, and that's expected. We've had a lot of people who are buying dairy products that have had enough dairy product right now committed for the big demand season. That's from Thanksgiving through Super Bowl. And Super Bowl's coming up. I'm happy to say our Packers are on track to perhaps be there again this year. We'll hope so. But we need to buy some cheese if we want to bump these lines a little bit, because most of our commitments are made for sales for cheese at this point. And the markets are looking at the inventories we have of those products, and they're feeling like they're adequate, maybe even still slightly heavy. So no need to jump in there and procure your milk supply early, or your dairy product supply early. That's why we're seeing this decline in milk prices. My forecast for prices is a bit more optimistic than the futures markets are, and I'm showing here that particularly with the all milk price. Positive factors: slowing U.S. and world milk production, declining U.S. stocks. We've had a relatively strong economy, and we've had some trade improvements out here. So those are all things for the good. On the negative side, our trade negotiations seem to be dragging along, and we are looking also at slowing growth in economies like China. still admirable growth from our perspective, but it's much slower than they've had in the past. So we need to have that continued emerging middle class to have strong demand for dairy products there. We've also seen that some of the economies of Europe are weakening. Germany, I believe, has technically been in recession, and France and the UK are not far from it. Brexit's weighing heavily on the UK. And I put there the possibility of US recession. We don't want that, and I hope we aren't going to experience it, but we have to keep it there in our forecast. So here's my forecast. This, I think, is probably a key after all of this talk. Watch the flush. The flush is going to be key. Our markets right now have been a little bit up one day, somewhat down the next day. They're banging around. They want and need some more information. I think the next big piece of information they get will probably be how much milk are we going to produce. If the flush is light this year, I think we can expect buyers to get nervous about just how adequate our stores of dairy products are. That would expect buyers to bid prices up early and perhaps quite high. If it's heavy, price strengthening will be slow for the year. So watch the flush. That's going to be the next key thing. I'm projecting that the 2019 all milk price, which hasn't been released yet, will be up about $2.35 or so, just a penny under that maybe. And that could continue to climb absent recession as much as another $1.30 a hundredweight in 2020. So a much better year. In my opinion, we could hit the $20 milk price again next year. Or actually, it's this year now. We've had a fundamental structural change in our dairy industry. It's different than it was in the 1980s, or at least the reasons are different. But it's been a pretty big change. Losing 10% of dairy farms is reflective, I think, of the pain that we're seeing in the dairy industry. Not all farms are going to be able to repair their balance sheets adequately to maintain themselves in the industry over the long run. And that's why I say I think farm loss is going to have a long tail. Even though milk prices are up in 2019 considerably compared with 2018, and I project them to be even better in 2020, it's going to take time to settle back into a new equilibrium. And with that, if we have a little bit of time, I'd be happy to take a question or two.
Very good. Thank you, Mark, for kind of looking into that crystal ball. And I know there's a lot of factors that come into play and a lot of data to go through, but we really appreciate you sharing your predictions for 2020. And as you noted, there's certainly a lot of questions still, or some asterisks there, but I think we can all feel a little bit of relief looking at the year ahead, maybe at least a little bit more positive and a better price situation than we've had the past couple of years. So thank you for that. Want to once again point out that Zimpro Performance Minerals is our sponsor for this webinar, and we greatly appreciate them being a part of this program. If you would like to listen to the webinar again or share it with somebody else, we would be happy if you would do that. You can find all of our archived webinars on our website, hoards.com, and then look for the webinar tab. And all the archives are there dating back to the beginning of our webinar program. Looking at the screen now, we have a couple of our upcoming webinars. All the webinars take place on the second Monday of the month at noon Central Time. And in February, we'll have a presentation by Michael Steele, who comes to us from the University of Guelph. And his presentation, Nutritional Regulation of Gut Function in Calves, focusing on both colostrum and milk that the calves will be consuming. So please make plans to attend that presentation. And that sponsor for the webinar is Cargill. In March, we'll have a pair of dairy producers speaking with us, Scott Prawley and his wife Pam Sells Prawley, and they have a dairy farm in north central Wisconsin, and certainly a high producing herd, and they have a lot of neat things going on with their dairy operations. So we look forward to them speaking with us about some of the things they do to maintain a 30,000 plus pound herd average on their cows. So those are our upcoming webinars. I think we had a couple of questions that came in. One that came in last week before the presentations, and then a few during the presentation here. So Mike, I'll let you go through that, and see we have quite a few here. So we'll let Mike help Mark answer those questions.
Well, very good, Abby. This question came in, as our listeners should know, that they can send questions ahead of time. And the good news, Mark, is I think you probably answered this one as well. But let's take one more swinger to summarize. I do yearly business plans for dairy. What do you suggest using for an average Class 3 price for the year? Can you break it out by quarter? Wow. What do you think?
Well, I certainly can, and I publish those. I don't actually have them pulled up right now, but I could do that. But when you're talking about business plans and planning, you'll see very much from that graph what those forecasts are. And I really recommend that people use, if they can, the all milk price for their state or at least their region that they're in. The reason is that the all milk price is not just the minimum price that plants have to pay, it includes premiums. And as we've seen in the last few years, those premiums can change quite a bit too. So I would use a all milk price or a change in all milk price as the best use for farm planning. If you take a look at this, my verbiage there that said I'm expecting another $1.30 a hundredweight. Use that in your own planning. Everybody's premiums are different, but if you're adding $1.30 to what you received last year in 2019, that's a pretty good planning price in most regions.
Okay, we also, another neat thing about this, and that is that we get comments in here. The first one comes from one of our people saying Germany's growth rate for 2020 projected at 0.5% growth, France 0.03. Mark, does that kind of fall in line with your expectations?
Yeah, it's a little bit better actually for Germany than I thought they'd had in the last couple of quarters. So, growth is pretty slow, and, there certainly is some concern. I think the biggest concern that I have is that if we've got economies that are faltering a little bit, we don't all want to catch the flu at the same time. We'd like to try to have this work our way through with slower growth. And 0.5% growth, 1% growth is nothing to really write home about, but it's better than being in recession. So if we can have slow growth while markets recover, that would be fine.
Here's a fun question for you, Mark, and that is came in. What the flush period? As a kid, that was usually meant cows went on pasture. Well, we don't have a lot of pastures anymore at least here in parts of the United States here. And flush is it more than we saw that production you saw there? But is that related somewhat maybe to schools shutting down, or we aren't going to buy cheese in the spring? What do you mean by flush season?
Well, by flush, I mean just what it sounds like. This is when we get a surge of milk production taking place. And, you're right. We don't have as many animals out on pasture as we did when that term was probably coined. But we still tend to see some of the same factors that influence milk production beyond just getting out on pastures. The daylight hours are changing, and that stimulates cows a little bit for milk production. Even though we are looking at breeding animals, all months of the year in most farm operations, we still tend to have a higher calving rate in that springtime. And so we're hitting the peak of lactation cycles for many of our dairies during that time period. There's just more milk being produced in that April, May, June time period.
Yeah, don't disagree with you there. Here's another one you can take a swing at. Don't dairy markets overreact? Why and how could this happen in 2020?
I do think that dairy markets tend to be a bit emotional. First of all, we have futures markets, and futures markets are just an amazing sponge for market information. They're trying to take in everything they can. They want to know about economies. They want to know about weather and weather patterns. They'll be getting a little bit nervous even about fires in Australia. So all of that stuff gets factored into what happens in a futures market opinions. And that oftentimes will spill into spot markets for dairy products like the CME cheese or butter prices, for example. And those, of course, in turn, get picked up in our surveys for national dairy products prices, and that gets used by federal milk marketing orders to form the basis of our minimum prices for milk class 3 and 4. So yes, our opinions do matter. They do change, and until we have information that suggests otherwise, those things move markets.
You did comment on Australia. Do you think that is going to have any impact at all with the fires in Australia, or is their market too small to have much impact in the oceanic prediction?
Well, their markets, they're the fourth largest exporting country of the world. And, they are a pretty good size dairy producer. They have been struggling for the last decade or more, and a lot of that with just drier, poor weather conditions that's creating a problem for pasture-based systems at the margins. And this year, the fires have taken a toll. I think I read somewhere where there's been like 30,000 cows lost as a result of the fires. So, that's a hit that'll be noticeable for Australia, and that will impact world prices to some extent.
Here's a compliment to you, Mark, and you can say something you wish, but appreciate your help with a Reader's Digest way to explain why producers are getting paid so well for milk protein. Do you want to make additional comments on that?
Yeah, the reason that protein prices are up is that our non-fat dry milk prices have increased rather substantially. Part of that was getting those intervention stocks down, and part of it's just been a strong demand, including from China. As I mentioned, that's been somewhat of a protein substitute for the pork that they aren't able to produce at the same level. So as those skim milk prices have increased right directly into our factors, that go into product price formulas, we're looking at cheese prices and taking butterfat prices from that to determine the protein value.
Another wild card is certainly we all heard about Walmart building their own milk processing plant. They're going to take it from the farm, put it in their stores. Are we going to see more of this in the dairy sector, where large marketers are going to say we're going to take control of the milk supply, and will that have some impact? What's your feeling on that decision by Walmart? And I believe there's some other stores also looking at doing that.
Yeah, and Walmart is not the first by a long shot. Our second largest milk producer for fluid milk in the country is Kroger's. They operate a few what we call captive plants. That's a retail chain that owns the processing. And, if you look in the South, you have Publix that owns processing plants. If you look in the West, you have Safeway that owns processing plants. There are a number of different retailers that own their processing, and I'm surprised in some ways that it took Walmart as long as it did before they decided to do that. There is some lowering of cost when they don't have to handle as many different SKUs in the cooler of a plant, or fill as many different products as they do in a plant that's providing not only their own label, but labels for other store brands and other items. So I think we may see more of that, but most retailers don't want to do that if they don't have to. That's a dilution of effort for many of them.
Another comment on beef semen. The use of beef semen on dairy farms has been a management factor on many farms. What's your opinion on the prospects of this continuing, or will this shift around, or what impacts will this have on dairy prices?
Well, I'm hardly an expert in that beef and livestock sector, but I'm told that these dairy beef crosses are providing some very nice carcasses with some highly desirable cuts. And, so I think that this is a good use for some of our lower end animals, as long as we know that they don't have the genetics that we want to propagate in the herd. We might just as well do that. And as long as we don't need those replacement animals, I think that it's fine for us to breed those animals, maybe particularly to sex semen, to get the heifers that we needed. So I think this is a not just a new trend, but probably going to be more of an everyday business for us as we go forward.
Here's a question, I think, Mark, that we can just say, go back and print off the results. Can you share the pounds of dairy products exported to Canada and Mexico in 2019? I believe you had that in one of your earlier PowerPoints that you shared with us. Did you not?
Yes. And, one of the ways that anybody can rather quickly take a look at that is if you go to the U.S. Dairy Export Council's website, which is just usdec.org. You can pull that off by country for major exporting destinations. And I don't have those numbers in front of me right now, but I would suggest you do that. You can find them quickly.
Okay, last comment here, and maybe you wish to comment as well. Comes from Holland. He says the positive side of genomics is that it stabilizes production and improves genetics, but it's sad to hear that 10% of the U.S. dairy farmers, the smaller ones, are going out of business. He said the same thing is happening here in Holland. Is this trend going to probably continue? Probably not totally related to genomics.
Yeah, I think it's related to economics more than genomics. But sure, anything that we have and do that, pushes for technology adoption that may be easier on larger farms, is likely to continue moving us in that direction. Honestly, in my lifetime, I think the one thing that seems like a long time ago now, but pushed us more strongly in the direction of larger farms was just the adoption of the bulk tank. It was an expensive piece of equipment to have on a dairy farm at the time, and you didn't have 12 or 15 cows and have a bulk tank on a farm. You needed 50 or 80 or 100 cows. So those kind of things just keep pushing us toward larger and larger herds.
Here's a last comment from, and it's a Hutchins comment. You're probably aware that we have the Canadian quota here in Illinois, one of our major milk marketing companies. We also have supply management. What's going to happen in 2020 if prices go up? Aren't these farmers that have supply management going to be limited as far as rebuilding or making changes? Your thoughts on that?
Well, supply management is really taking place today with individual milk handlers, primarily cooperatives. So, your cooperative may have a plan in place. Whether they've chosen to implement it or not is another question. But that's in place if we produce more than we can profitably market in a given region, and may not even have the processing capacity in the region to handle all the milk production. It's too expensive to move it long distances. So you may have some of those restrictions triggered. But I think as long as we have reasonable markets and processing capacity in a region, we would have an opportunity to produce more milk and sell it. That, in my opinion, was one of the biggest reasons that we saw milk being dumped all through the Northeast, and in some cases through the Midwest the last 2 or 3 years, that we just didn't have markets, adequate markets for the product that would be the residual that took that milk.
Well, Mark, you've done an excellent job handling all the questions in a very quick manner, and we appreciate that. Abby, we'll turn it back to you to wrap up our webinar for the day.
Very good. Thank you both. Once again, want to give a great big thank you to Mark Stephenson for joining us today, sharing a wealth of knowledge on the topic of price forecasting for the year ahead, and very useful information here. So thank you, Mark, for taking the time to be with us today. We want to thank Zinpro one more time for being a sponsor for this month's webinar. We certainly appreciate our sponsors that support these webinar programs so that we can share this information with all of you in the audience. Our upcoming webinars will be February 10th, and we'll be focusing on calf nutrition, presentation by Michael Steele from the University of Guelph. And then in March, we will have dairy producers talking about their dairy herd and how they manage and maintain a 30,000 plus pound herd average. So please, if those topics interest you at all, make plans to join us once again. And then last but not least, I'd like to thank all of you in the audience for taking the time and choosing to spend an hour of your day with us. We certainly appreciate it, and we look forward to offering another great series of webinars here in the year 2020. So until next time, I'd like to say goodbye from all of us here at Hoards Dairyman and the University of Illinois. Please take care, and we hope you'll join us again someday.